Happy Thursday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Thursday, February 15th, 2024. As always, we'll start with our executive summary from today's leadoff morning note. If you would like the analysis supporting these conclusions, as well as what to specifically do about them, you need to be a client of 42 Macro. So we'll start with today's key macro event, which is Japan and the UK record technical recessions, plus an interesting divergence in the resilient U.S. economy. So the nuance there is Japan, now the world's fourth largest economy, slipped into a technical recession last quarter with an annualized real GDP contraction of minus 0.4%, which is the highest since 2Q23. The UK economy also slipped into a technical recession last quarter with real GDP contracting 30 basis points quarter over quarter, which is the lowest since 1Q21. Elsewhere, asset markets are struggling to figure out how to digest the soft January retail sales print in the U.S., which saw headline growth contract minus 1.8% on a 3-month SAR basis, which is the lowest since April of 2023. Core retail sales growth slowed sharply as well to a well below trend 3-month SAR of 1.4%, which is the lowest since April 2023 as well. The January industrial production data disconfirmed any hard landing fears reignited by the January retail sales release. Industrial production growth accelerated sharply to an above trend 3-month SAR of 0.8%, which is the highest since September of last year. In terms of market implications, has the clock struck midnight for the U.S. consumer and by extension the U.S. business cycle? Likely not. This morning's initial and continuing jobless claims data confirmed our prior fundamental view of a low probability of a developing recession in the U.S. economy. That view is being confirmed by the 42 macro Fab 5 recession signaling indicators. It is also being confirmed by the latest Federal Reserve credit delinquencies data. As a continuation of the resilient U.S. economy theme we authored in the summer of 2022 is supportive of the current Goldilocks market regime, which appears to be headed for a phased transition to reflation in short order per our quantitative risk management summary review. Today's leadoff morning note for more details on that. So transitioning to my 42 macro dashboard here, as always, we'll start with the trading range signals from our friends over at Longbow. In terms of say overbought, oversold signals today, so still getting an oversold signal in gold this morning. Not quite an overbought signal in Bitcoin, but certainly hugging the upper boundary of its probable range ahead of the halving, which could be something that investors experience for quite a while. When assets are in a bubble, and actually I don't want to call it bubble because that indicates, that sounds like I'm bearish on Bitcoin. We're very much not bearish on Bitcoin. It's a large position in the KISS portfolio construction process and has been for a while. When assets are really starting to melt up, they tend to hug the upper boundary of any probable range or any trading range process, any sort of mean reversion based tactical trading process, whether it be the Longbow signals, our probable ranges, or anyone's ranges for that matter. They're going to spend a lot more time hugging the upper boundary of that range because, again, markets are not going to allow people who aren't participating to get in. Bitcoin is not going to give you a favorable price to get in once it starts moving, particularly if it's moving ahead of a real underlying fundamental catalyst such as a halving. So just be aware of that. When you're seeing those signals there, it doesn't necessarily mean that it has to correct to the lower boundary of the probable range anytime soon, because there's a lot of people on the sidelines that are staring up at the price that are not going to get let in, because this is how markets work. So transitioning to our 42 macro aware community, just wrapping up with a question here from one of our clients that says, given what appears to be the ongoing and increasing inflows into Bitcoin via the ETFs, is it possible that the historical drivers of Bitcoin price appreciation will evolve over time? Put it another way, could the ETFs materially change the nature of the Bitcoin market? If so, how and when could that conclusion be drawn and integrated into the model? So the few things I'll say on this question, because I think it's a great question. The drivers of asset classes change all the time over time. So that's two statements. They change all the time over time. And so when you think about what's driving asset classes, on a kind of, multi-year basis, 1 to 3 years, you could have one particular or two particular themes, or more than that, but generally speaking, you're gonna have 1 to maybe 3 themes really drive an asset class over a short period of time. And those things that are driving the asset class, those particular things, whether they be cyclical growth or cyclical inflation expectations, whether they be U.S. liquidity or global liquidity, things like that, that stuff will matter, but that it'll change over time as well. So what matters to Bitcoin today, what's really driving Bitcoin today in terms of the covariance that we're observing in our models, or the principal components that will drive Bitcoin in our models as well, those things will change and evolve over time. So that's something to be aware. That's something that's not a Bitcoin thing. That matters to every asset class. Things like that. So that's something to be aware of as an investor. And secondarily, when you think about how the inclusions of the ETFs are likely to impact the Bitcoin price, in our opinion, it's just going to make Bitcoin behave more and more like traditional risk assets. We've seen that really since 2020, 2021. Bitcoin has moved in pretty much lockstep with broader measures of market risk and broader risk assets. And in our opinion, the inclusion of the ETFs, which is taking trillions of dollars of, or it's creating a potential demand pool of trillions of dollars of institutional and or investment advisor and or retail capital that historically it was not participating in the asset class. All of the legacy fundamental drivers that those investors believe in to be driving risk assets are going to be superimposed onto the Bitcoin price. So more traditional things that are endemic to the crypto ecosystem, I don't even know if I can name more than one, kind of a Coinbase type. Not Coinbase. What's that data provider? Let's not don't ignore all this. But the traditional things that are endemic and native to the cryptocurrency asset class that have historically been drivers of price will become diminished relative to things that more traditional TradFi investors tend to be focused on, which is growth, inflation, and policy. Those are the three dominant drivers, three principal components of pretty much any and every asset class. So we'll wrap it up there. Darius Dale presenting our macro minute for Thursday, February 15th. Everyone have a wonderful day. Best of luck out there. We'll catch you back here tomorrow. Cheers.